Good afternoon, ladies and gentlemen. Welcome to panel discussion hosted by the Responsible Finance Institute. My name is Bartosz Bacia, and I will be moderating today's discussion on the role of ESG factors in credit risk analysis. We have outstanding guests today with us, joining our stream from London and Paris. I would like to welcome Yulia Sofronova, Andrew Steele, and hopefully rejoining us later on, Robert Patalano. Let me briefly introduce our panelists, starting with Yulia. Yulia is co-head of Nordics, CE and CIS in the signatory relations team at the United Nations Principles for Responsible Investment. Yulia leads PRI's work to promote responsible investment and sustainable practices across CE and co-shares this responsibility across Nordic countries. Our panelist Andrew Steele is joining us from London. Andrew serves as a managing director and global group head at Fitch Ratings. Andrew is responsible for developing and implementing sustainable finance strategy at Fitch, across ratings and broader Fitch Group. Andrew's group is based in London, New York, and Hong Kong. Now, I would like to make some introductory remarks on our topic, starting with big picture perspective. As you know, the financial markets are really at point of change on the side of investors' preferences, which are shifting towards products labeled as sustainable, products which incorporate environmental, social, and governance factors. As you know, the European Green Deal plans to strengthen the foundations for sustainable investment, and the ESG considerations in the investment research as well as investment decision-making process are vital to protect the value of the investment. Therefore, identification and mitigation of ESG risk should be adequately integrated by all stakeholders in the financial market. One of the reasons this transformation is occurring right now are the regulatory triggers, are regulatory grounds which are deeply rooted in the regulatory means introduced by EBA and ESMA. The new set of regulatory measures encompass inter alia EBA guidelines for granting and monitoring of loans, as well as ESMA guidelines on the required disclosures related to credit ratings. ESMA, as you know, has also published draft technical advices for the European Commission regarding amendments to MiFID II UCITS and alternative investment fund managers directives containing proposals to include ESG risk assessment in the operational requirements for investment firms, investment funds, and also, as you've seen before, credit rating agencies. So our focus today is approaching the question of role of ESG factors in contemporary credit risk analysis, as well assessment on how the change in analytical perspective will affect the assessment of specific asset classes by institutional investors and also by credit rating agencies. So now I would like to start with Yulia. Yulia, as UNPRI representative, I believe our audience would be keen to know what is your perspective on the shared challenges of assessing ESG issues in credit risk by credit practitioners at both investor and credit rating agencies level. Also, if you could enlighten us and shed some light on the role of PRI and its ESG in credit ratings initiative in addressing the challenges related to the role of ESG factors in credit risk analysis. Please.
Thank you so much, Bartosz, and thank you, everyone. Good afternoon. It's a pleasure to contribute to today's discussion. As Bartosz mentioned, in my role at the Principles for Responsible Investment, I work with institutional investors from Nordic and Central European countries to really support their integration of ESG strategies. And what it ultimately means is that we guide them through available to them tools and resources and try to find the ones that are most suitable to their investment strategies and to their mandates. For those of you who are not familiar with the Principles for Responsible Investment, we are a membership institution that promotes ESG assessment as a risk management tool, and we provide investors with different tools and actions that they can take to integrate ESG into their investment decisions, into different asset classes, and including in fixed income. So what I'd like to talk about is, as Bartosz mentioned, highlight some of the trends that drive the ESG adoption across different capital markets. I'd like to demystify some of the confusion that exists in the market around what ESG consideration in credit risk analysis is about, and also talk briefly about some of the challenges. So at the PRI and amongst our members, we see three main trends that drive the adoption of ESG strategies across different capital markets globally. First of all, that's an increasing understanding of academic research out there, practitioners' research into the materiality of ESG risks, and evolving evidence around the fact that by integrating ESG risks, investors don't actually have to sacrifice their financial returns. And secondly, what it leads to is more investor awareness about the materiality of ESG and more demand from institutional investors, especially asset owner clients, to integrate more ESG into investment decisions. And I'll give you an example. About 70% of our members globally are investment managers who come to us because they either come to realization that ESG assessment can only enhance their risk management practices, and or because their clients are asking them to integrate ESG into their investment decisions. And finally, also important point that regulators are catching up with market practices, and we're seeing that ESG regulation globally is emerging, both on the corporate disclosure of ESG issues, but also on the institutional investor side. And a good example, recent example in the EU is developments of the EU taxonomy, as well as the ESMA regulation. So important point here also to bring to this conversation is that compared to equities, ESG integration in fixed income is relatively new due to the complexity of its asset class. And PRI was one of the first organizations to realize the importance of engaging investors and credit rating agencies to enhance their understanding of the impact that ESG can have on the ESG assessment in credit risk, as well as to promote sustainable investing in fixed income asset class. And we've launched a dedicated project back in 2016 on ESG and credit risk and ratings, which brought together investors and credit rating agencies to identify the challenges and work together on solutions. And today, more than 100, I think it's 160 investors in fixed income, as well as 22 credit rating agencies globally support this work. And the project, what the project find out is that there are some misconceptions about what ESG really is in credit risk, and some of the common challenges of addressing ESG in credit risk is due to how do I understand what ESG risks are material to credit risk? What is the likelihood of those risks to materialize? What are the time horizons do I need to consider? And most importantly, how to distinguish what ESG risks have already been factored into traditional credit ratings, and if they're not, what further ESG analysis credit practitioners need to undertake. And the misconceptions in the market that I also wanted to spend some time to talk about is mainly around, first of all, this confusion between the market participants that ESG in credit risk is similar to ESG credit is ESG ratings, which are non-credit products offered by service providers, the likes of MSCI and Sustainalytics. And while those two tools are complementary, they're actually quite different. So, for instance, the ESG non-credit rating score would evaluate the exposure of a bond issuer to particular ESG risks, but those risks that have been factored into this analysis might not necessarily affect the credit worthiness of an issuer. And that's important to understand. And also important element here is that ESG service providers are not regulated, whereas credit rating agencies are regulated. And at least in Europe, we are now seeing clear signal from the regulator to make the assessment of ESG more explicit in credit ratings. And second misconception is around the fact that market participants think that ESG in credit risk means or leads to exclusions. And of course, it might happen as a result of a credit assessment undertaken as an exercise, but it doesn't mean that the actual exercise of assessing credit risk will automatically lead to exclusion. So, for instance, climate risk is becoming more obvious that it affects credit worthiness of issuers in particular sectors. And after the assessment is complete, an investor might make a decision that they will exclude specific issuers from their investment universe because they're highest emitters of CO2 in this particular sector, etc. But this is an ultimate informed decision of an investor. And the assessment itself doesn't mean that it will automatically lead to an exclusion. And I also wanted to bring the last point because green bonds and social bonds are becoming very popular in the market. From a credit risk perspective, assessing green bond or a mainstream bond doesn't necessarily make a difference because it doesn't matter if the green bond is labeled as green. It actually doesn't mean that it is less likely to default. So it's important to consider that element as well. And also the social and green bonds is still a relatively small fraction of the whole fixed income market out there. So it's important to bring more consistent integration of ESG and make it more mainstream across all the different fixed income instruments. And obviously credit rating agencies have a crucial role to play in this process. And which actually on this point I wanted to highlight there is a great effort by credit rating agencies that have been done in this space, both large global credit rating agencies but also small regional ones, to be more transparent about what they've already started to incorporate into their credit ratings, because there are at least two approaches. You can develop a built-in or you can add on ESG into your credit ratings. And if it's a more integrated approach, then of course it's very important to communicate to market participants what's included and what is not included. And with this, I also wanted to highlight that the credit rating agencies have started to publish different sector or thematic research on ESG in credit risk. They've started to publish examples of where analysis of ESG risks have led to the change of their credit opinions or outlooks, and it's very helpful to the market participants. With this, I would like to also conclude and welcome the audience to read more about the project and the reports, and we also provide quarterly reports on progress, which both include examples from credit rating agencies, from investors' case studies. So I welcome the audience to read those reports and also stay tuned, because the next phase of this PRI's project will also include bringing issuers to the discussion, and as well as ESG non-credit service providers, which is important because it links back to some of the confusion in the market. With this, I would like to stop and pass on over to Bartosz.
Thank you very much, Yulia. Certainly, the perspective of the market standard setter as UN PRI is quite valuable to our audience. As you have noticed, ladies and gentlemen, Mr. Robert Patalano has joined us from Paris. Welcome, Robert. Thank you for joining us. I would like to briefly introduce you to the audience. Robert is a Deputy Head of Division in the Directorate of Financial and Enterprise Affairs of the OECD. Rob manages the OECD analytical work on sustainable finance, including ESG practices and the implications of climate risk on financial markets. Rob, we know that the OECD plays a leadership role in researching ESG factors in financial markets. Given the issues you have researched about the significant inconsistencies in methodologies, metrics, and results of the ESG assessments, what would you propose to address these issues?
Sure. So thank you very much, Bartosz. I appreciate your efforts and that of your team to set this up. It's an important topic, so I commend you for bringing it into this international webinar, and welcome to the peer panelists as well. I would like to talk relatively briefly, about the situation with ESG. I agree with Yulia's points entirely. In concept, I think ESG is really important for sustainable, not just for sustainable finance, but to support sustainable growth. And the OECD is really committed to finding ways to unlocking innovation in finance and the economy for sustainable growth. I guess that what I'd like to talk a little bit about today is the growing pains. So you could say either ESG, I think ESG is beyond the early stages of development, but let's consider it an adolescent that is on the right track and is dynamic, but has some growing pains. And since I come not just from the OECD, but from the Committee on Financial Markets, we care a lot about those growing pains because they can create some inefficiencies. And then we want to address those along the way to make sure that this practice is resilient and effective. So I guess what I would like to talk about today, there are 4 issues, and I'll try and cover them efficiently. First, I want to discuss about what sustainable and responsible investing is from the standpoint of the Committee on Financial Markets and our mandate, because I think it's relevant more broadly in the discussion. Second, I want to spend the most time in talking about the highlights of our assessment to see if ESG is really delivering on, I won't call it its promise, but I would say what investors expect out of it and where it can go. And then third, I'll talk a little bit about ESG and credit investing, and I would, of course, defer to our panelist, Andrew Steele, because he has the expertise in that, but I'll make some high-level comments that I think there's a lot of value on the credit side, not just for credit, but to make the entire ESG process more rigorous. And then fourth, I'll touch on policy, because I think that's ultimately your question and where you'd like to go. So in terms of responsible investing, the mandate of our committee is to promote efficient, open, stable, and sound market-oriented financial systems based on high levels of transparency, confidence, and integrity to support sustainable and inclusive economic growth. Now, I think we can all agree that sustainable finance is there to channel capital to help support sustainable and inclusive economic growth. But as well, we have to acknowledge that this surge of interest in ESG and the surge of usage, where trillions of assets under management are now managed so-called according to ESG or into ESG integration, that it doesn't really quite rise to the standard of high levels of transparency, confidence, and integrity. And that is something that we need to work on to make sure that it benefits the end user in society. So I would say, unlike financial reporting, there is no set standard or approach for how ESG is presented, how it's disclosed, how it's presented. So while we have a lot of standard setters that are involved, or disclosure standard setters, et cetera, there is no common standard. And we need to think about what the pitfalls are there. And then the very good progress has been made, but now there's sort of a constellation of approaches and an overload of information. So even issuers and investors are saying they're overloaded with the number of players who are involved with different approaches that are not fully transparent. So they can't quite understand how these players, how these ratings providers got to their outcome, because they don't understand the methodology and they don't know exactly which metrics are being used, how they're being weighed. So there's a challenge. So OECD engages a lot with private investors. We heard feedback from investors, even from the rating agencies and ESG rating agencies, and from central banks themselves, because central banks, as you know, many of them have signed up to UNPRI and are committed to responsible investing and ESG integration, and they need to know more what it is and what it's not. So we undertook a few research areas of research, and I want to talk to you a little bit about our conclusions. So the first element of research was to try and find out, does ESG actually align, do the scores align per company, per issuer? Credit ratings, generally, you're not going to find a country or a company that is issued AAA or AA by one agency and CCC by another, because there are set metrics. The metrics are clear, and if you go well beyond, you can use judgment, but when you go beyond certain metrics, certain benchmarks, it's just not going to be high investment grade or low non-investment grade. ESG does not have that at all. So what we found was, I think we selected a number of companies that were larger companies within different industries, and we found that the ESG ratings across Thomson, MSCI, Bloomberg, and Sustainalytics varied. We tried to average it onto a 10-point scale, and you could have, in many cases, one company getting from one agency a 2 and another one getting an 8, which it begs the question, if you're the investor and you're trying to pick a high ESG portfolio and trying to figure out what assets you have, and what ends up in your portfolio is determined more by which rating agency or rating methodology you use. That can be a challenge. And that is certainly a challenge that needs to be overcome to make this credible and trustworthy. Then the second issue we looked at is what actually does it mean for the ratings to actually be financially material? And we looked across these same players and looked at these ratings that are either publicly available or commercially available. And we found that ESG, the performance over the past 10 years on an absolute basis, comparing ESG indices to traditional indices, and we tried to match up styles, and on a risk-adjusted basis using a Sharpe ratio, Trainer ratio, and some other metrics, showed that there was no systematic overperformance, and in some cases, on a risk-adjusted basis, there was underperformance. And part of the reason is if you think about it, if you're excluding some companies and you're tilting more towards some other companies, you will create a bit more of a concentration in many cases, and that leads to higher volatility. So it's just portfolio theory playing out in the evidence. Now, there's nothing wrong with that. And in some cases, investors may want to give up a little bit of financial return to get more social returns or ethical returns, or to simply have ethical standards in their portfolios. I think what concerns us is that there are a number of players who are saying, you can have it both ways. You can have enhanced financial returns because we're unlocking knowledge from this information, and you can rest at night knowing that your portfolios are going to be green and they're more socially responsible, et cetera. And I think, again, coming to the adolescent analogy here, we really don't know what to make of the approach, because in some cases, investors may be getting neither. So that, and I'll explain that. So that turns to our third effort, which is we have a lot of central banks who are part of the Network for the Greening of the Financial System. They're committed to greening of the financial system, and they're using ESG. And they believe that the E of ESG is going to help them with their reserve portfolios to green the financial system. And a simplified view of that is, I want to invest in companies that have less of a carbon footprint now. Of course, there can also be transition strategies, but If you want to have an immediate impact to change pricing, to signal changes in pricing, you do it now. So what we found, again, using the analysis of these very well-known rating providers, what we found is that the E pillar of the ESG, we compared that to the actual CO2 of the companies within the portfolios, and what we found is that there's either no correlation between the E of ESG and the amount of CO2, scope 1 or scope 2 carbon footprint, or in some cases, in one case actually, there was a positive relationship, which is bad. It means the higher the E score, the more of a carbon footprint you have in your portfolio. And we also looked at the index to say this can't be true. So we looked at the index and we found for some major indices that if you looked at the ESG version of the index versus the traditional version, you saw a higher carbon footprint. Now, of course, the current carbon footprint isn't the only thing you're going to have in the E. It's also transition plans, it's also risk management, et cetera. But the point is, when we talk to institutional investors and some central banks to say, were you aware of this? There was a bit of surprise, because I think the expectation is somehow that ESG is going to solve all of these problems, notwithstanding the good efforts of UNPRI and some other players who are trying to promote the reality of what it can do and what it can't do, and that you have to do your homework. These are the generalizations of some pretty sophisticated investors who perhaps are already becoming over-reliant on ESG. Okay, so then let me just jump to what the implications are for credit. One additional piece of analysis that I haven't mentioned yet is we looked at the downside risk. So do ESG portfolios have less of sharp downside movement relative to traditional portfolios? And then what was the experience during COVID? And what we did find is that ESG portfolios, while they may not outperform, particularly during periods of upside gain, which we've seen during monetary policy over the past 10 years, there's been a lot of upside gain. They haven't outperformed there, but they have lost less than traditional portfolios during periods of stress. And COVID certainly played that out. So you see, during the past few months, ESG portfolios have been relatively resilient, and that's a good sign. So what does that mean for credit? If I were sitting in a rating agency, and in fact, I was there 20 years ago working on corporate governance, and then the rating agency said, actually, we already do this and we combine it within our traditional portfolio. So to Yulia's point, it's really important to determine what's already captured versus what is the incremental ESG. But I think that there is a benefit for using ESG and credit for two reasons. One, rating agencies, their reputation is on analytics, on sound judgment, based on decades of experience. And they will have to look at this new form of ESG and put it side by side with their long history of generally getting the credit calls right. Because you can see the effect over a business cycle. You can see how right you were. And then if you look at the ESG, they're really going to try and see how they can integrate ESG into their credit rating, but then make them distinct so that people can judge what is the traditional credit rating, which is really quantitatively driven, versus the ESG, which at times can be much more of a judgment call. And if they can get this right over time, I think there will be positive spillover effects for the rest of the industry, because this isn't really how equity markets work. 1,000 views flourish in equity markets, but because we say there are standards, people have the impression that there is one standard as to what a good ESG company looks like or a bad ESG company, and that a portfolio full of good ESG companies can only look like one type of portfolio. So I think there's a lot of work to be done there. So I hope that the credit folks can do that. I guess I'm running out of time, so I won't go into some of the regulatory issues, but I'm open to questions. I would say in terms of policies, there are just perhaps maybe I'll mention three things. One, to my point, you need to have transparency, consistency, and credibility. So transparency of methodologies. I know different rating agencies don't want to be entirely transparent because they have intellectual property, but there needs to be enough transparency of the methodology so a user would have some idea if rating agency rated something highly and rating agency B rated it, as one of the worst ESG performers or ESG companies, you need to know basically how they arrived at these very different results. Because if you don't, then it's very hard to determine which methodology you prefer for your own portfolio. And I think that needs to be addressed. Second, while the categories of E, S, and G are very clear, because it's an acronym used by all of these players, the subcategories of what are the metrics below that or the categories below that, and then how are the specific metrics. And there could be over 1,000 metrics. I read that S&P uses over 1,000 metrics to judge, to come to an ESG score. So how they use, which metrics they use, how they weigh the metrics, and how they layer on judgment on top of those metrics, there needs to be some level of clarity around that so you know how they got to their results. And this isn't just individual investors saying, I don't know how they do it. Some of the largest asset managers in the world have been at our committee meetings saying, we try and we're using our own analytics and we just cannot back into how they got to these results. So how do we communicate this to our clients if we're relying on their ratings? So this is an issue. And then I would say in terms of regulations, I think this will be my last point. The EU, the US SEC, JFSA and Japan are all making progress at different paces because ESG has matured at different paces in these regions. They're all making progress to try and deal with investor protection, to deal with appropriate disclosure regimes, and to deal with market integrity to make sure that the products are labeled in the right way in taxonomy. This is very good. The challenge is they're done at a jurisdiction level or regionally. And the issue, as you know, is that markets are global and some of these large players are global. So unless you have standards across the globe, at least linking major markets, you're going to have different rules in different ways at different paces, and it could actually add to some of the inconsistencies in the markets when global players aren't sure what norms they should be using. And that's why I think it's really important that at some point, there's going to be a global standard for disclosure and for rating methodologies at a very basic core level of good practice to make sure that we get this right so that markets function for users and for society more broadly so we can have more sustainable economic growth. So thank you for that.
Thank you very much, Rob, for this. Your position reminds me the one of Jay Clayton, the current SEC chairman, regarding potential for improvements of methodological standards in ESG research. And also you mentioned EU. As far as I recall, Stephen Mayor, the current ESMA chairman, expressed earlier this year his view on the possibility or even necessity to impose regulation on ESG rating agencies. So as you know, all of them, they read OECD research pretty intensively because their conclusions, they totally comply with your position. So thank you very much. Now, Andrew, as a practitioner, I would be eager to know in terms of of E, S, and G letters, which has the biggest influence from your position on credit ratings profiles and why?
Thanks, Bartosz, and thank you very much, Yulia and Rob, for doing such a good job of setting the scene and the groundwork on the bigger picture. I have to confess we are a PRI signatory, and they have done a fantastic job in terms of bridging the dialogue between the different market practitioners to get more of a common understanding. Rob, I'm not sure whether you've completely terrified the audience about the adolescents running out of control, but hopefully not. So Bartosz, in answer to that question, the short answer to that is when it comes to credit ratings, governance has far more of an influence on credit ratings than either social or environmental risk factors. And actually, as a general theme, social risk factors currently have more of a credit impact on ratings than environmental ones do. And I can come to talk a little bit more about why that is later on. But before I do that, I'd quite like to just continue the themes that Yulia and Rob started off on and expand those into the world of credit and what it means when we're actually looking at individual entities and transactions and how we've approached integration of this type of analysis into our credit ratings work. One of the most important things I think to highlight straight off is that these risks are not new risks that have suddenly materialized. They are risks that were always there. And therefore, the commentary that's been made about transparency is really critical when it comes to credit. And what has changed is that asset owners have asked asset managers to start reporting on the impact from these areas of risk. And they've asked for them to be reported as a separate subcategory. And a lot of the work that we've done as a rating agency to integrate this into our rating processes very quickly started to show us that when you look at an individual aspect of environmental risk, social risk, or governance risk, when it relates to a particular industry sector, it does not map neatly to an individual area of traditional qualitative or quantitative analysis that you'd see fixed income investors and credit analysts undertaking. And that's one of the main reasons why we think there is so much difficulty in achieving common standards at the moment, because it doesn't fit nicely and neatly into the existing analysis framework. One of the other things that that Rob and Yulia talked about was about the difference between credit risk and equity risk. And I'd like to emphasize that credit risk is about downside protection. And a lot of the ESG ratings that you see outside of the credit rating agencies are largely looking at a holistic view of how good or bad an entity's ESG practices are, but not looking at how they relate to credit. And I think Rob made a very good point, which is, when it comes to credit, you can actually have a very bad ESG practice that over a shorter term credit horizon could actually be very credit positive for an entity if there are no consequences to it. And so where we found ourselves as a credit rating agency several years ago was a whole stack of investors saying to us, look, we want more detail on exactly how these E, S, and G risks are relevant to credit. And if they are relevant, then we want to know for individual entities and transactions how material that risk is when you're making your credit decisions, not whether or not environmental aspects are important for the natural resources sector, but if you're a copper miner, is this going to impact you in the next 3 to 5 years? And if you're a copper miner in Europe, is it different from being a copper miner in Latin America? And we looked at what had been done in the market, and we saw that largely the credit rating agency's response to investors over several years was, well, you don't need to worry too much about this, because if it's material, then it's already included in our analysis. And I think Rob alluded to that in some of the research that they'd done. But the issue there is then, how material was it? And did it really change your view on the ratings? An important thing to distinguish is also when you look at the credit rating agencies, and Rob talked about this in terms of regulation, there are two different approaches going on at the moment. So for ourselves, we took the decision that we would fully integrate the transparent display of these risks into our ratings business. And so that's the regulated ratings business. And that means that you have to comply with all sorts of default and transition study requirements from regulators, and to be able to back test what you're doing and demonstrate the consistency and the calibration of your scoring systems. Those agencies that have gone down the route of doing separate holistic ESG evaluations, as market participants, you need to be very aware that those are not within the regulated rating businesses for those entities. And therefore, they fall into that category that Yulia mentioned earlier on of essentially service providers. So, you need to be careful when you look at credit rating agencies to distinguish between what ESG activities are actually falling within the regulated side of the business and what is actually just really a replication and a rebranding of a service provider style product. And that's actually quite important. And there's quite a lot of blurring that goes on in marketing literature around that. So what we found was, investors were asking us, what is relevant on a sector by sector basis, and if it is relevant to a sector, then how does it impact individual entities? And so what we did was we looked at this and we thought, well, if we're saying it's already included, separating this out should not be too difficult. And so we embarked on a process of extracting the elements of environmental, social, and governance risks that were contained within our existing ratings criteria, and then displaying them separately on a templated basis for each and every industry sector that we have, ranging from non-financial corporates through to banks, insurance companies, sovereigns, covered bond transactions, or municipal entities. And the result of that was we came up with 96 different industry sector templates. And in those sector templates, you can see general risk categories for environmental risks, social risks, and governance risks. And those are consistent across the categories. And then alongside those, you can see the elements of risk that we feel from a credit perspective are relevant to that particular sector. So if you're looking at greenhouse gas emissions for automotive manufacturers, for instance, the credit relevant aspect from our perspective is the emissions and pollutants from the vehicles being manufactured and sold. And then alongside that, as part of the exercise that we went through with all of our 1,400 analysts, was to identify where in the traditional qualitative and quantitative analysis that we would normally undertake, that risk would materialize if it occurred. So what does it affect? If you're an automotive manufacturer and you get that wrong, potentially what's the harm that it does to your credit profile from a qualitative or quantitative perspective? And so in each of these templates, you can see the sector specific issues that we identify, and you can then see how those relate to traditional analysis. And so, for instance, in that automotive example, the traditional analysis that would be most impacted by getting that wrong would be brand positioning, profitability, and ultimately financial structure. And as we went through this process, one of the things that it showed us was that even within a sector, once you've identified what these elements are that are relevant, you can then score individual entities and transactions for the materiality of that risk aspect to the credit decision that you're making. But even there, the materiality is not as straightforward as saying, well, this is a 7% impact for the automotive sector. Because what you discover is you discover that the business and financial profile of the entity has a very strong influence over how that risk aspect materializes in the credit profile. So for instance, if you're a highly leveraged entity, then you're much more likely to see damage in your financial structure through having to raise additional debt as well as profitability. If you're cash rich, then your financial structure may survive unscathed from that type of risk. So that was an important point that I wanted to make. It is not the same for every entity, even within a sector. This stuff is complex and it's difficult. It took us quite a long time to do this, but now what we have done is we've integrated the transparent display of these risk categories into our credit ratings analysis for every rating that we produce. And that means our 1,400 odd analysts are monitoring and maintaining over 150,000 different scores on about 11,000 different entities and transactions. So we've gone for that end of the spectrum that Yulia was talking about, which is really full integration, but full integration on the regulated ratings side. And it's actually quite important to emphasize that. One of the other things that I'd like to touch on is that timeframes were mentioned earlier on by my fellow panelists, and timeframes are very important when it comes to ESG risks. And by integrating it into the credit side for ourselves, what we've done is we've locked that timeframe into the forecast that we're looking at to create the ratings. And that's relatively short term from a credit perspective. And so some of the other work that I think Rob was alluding to that really needs to go on is how do you then, if we're looking at a 3 to 5 year time frame, we can tell you what the risks are from a credit perspective for an individual entity or a transaction. But then if you're a portfolio manager and you're looking at a range of bonds that run up to 15, 20 years for an entity, what you then need is you need to understand, is it more risky for me to invest in oil and gas now than it is in 2025? Or actually, does it really not make a difference between now and 2032? Because there's still enough demand coming through until 2032 that the risk side for oil and gas doesn't escalate. Whereas the transition for automobiles to electric vehicles might mean that actually there's a crunch point that occurs in 2028. And a lot of this links back into some of the work that the UNPRI is also doing, looking at what we would consider to be one of the most risky parts for credit surrounding ESG as a whole, which is ultimately where you see the risks materializing in credit profiles, particularly on the environmental side, which I mentioned at the beginning was the least impactful at the moment on credit, is that gets driven largely by regulation, and regulation forcing the cost of things like carbon into entities' credit profiles. And there you can see some of that starting to happen with utilities in Europe, and a very different aspect in the US at the moment. But ultimately, as countries try and move to a transition target to a low carbon economy, what you see is that the bigger the gap between achieving what they want to succeed in the market delivering, the more likely it is that some of those changes will be forced by regulation. And those forced changes are actually very difficult for companies to cope with. As you can probably guess, we can talk about this stuff for a very long time in terms of background, so I'm probably going to call a halt to it there. But perhaps the couple of points that I would like to emphasize is, please remember these risks are not new, but it is all about the detail. It really does matter on an entity and a transaction-specific level from a credit risk perspective. Do think about timeframes when you're looking at some of the bigger picture analyses that you see that say natural resources are a disaster. And when you're looking at these risks, think very carefully, and this will be my final point, think very carefully about what is the transmission mechanism that causes that risk to crystallize for an individual entity or transaction. And the thing that I will leave you with is, when we look at our portfolio of natural resources companies globally at the moment, they suffer far more impact from governance issues and social issues than they do from environmental ones. They know generally how to manage the environmental ones. Where they suffer problems is where an operational procedure isn't followed correctly, so there's a governance issue that results in an accident or a spill, and then you get a big fine from an environmental impact. But if you're a credit investor and you're trying to avoid the downside risks, then you need to be able to identify what causes that risk to materialize, and then you can analyze a company and understand whether that company is actually extremely good at managing that. And if it's better at managing that than its contemporaries, then generally it will suffer a lower level of risk of the downside occurring.
Thank you, Andrew. What I conclude from your presentations, I would say that it is this underlying difference between ESG assessment and credit rating, because this is a difference between a regulated product, which is legally defined by EU regulation, where a credit rating is an opinion on creditworthiness of an entity of an instrument. And in case of ESG assessment, it is an assessment of resilience of an entity vis-a-vis ESG risks. So how would you define the role of both assessment types of assessment in current credit risk analysis? Because Yulia touched upon the issue of complementarity. How do they bring together added value? And secondly, because we observed in the past such so-called over-reliance on credit ratings, and it was heavily fought back by regulators both in the US and in Europe. Do you think that when ESG assessment will be subject to regulation, as Stephen Major announced earlier this year, would it be also the case with ESG ratings or ESG scores or ESG assessment? Because, as you know, investors more and more look at this ESG side of investment. How would you comment on that, starting with Yulia?
Thank you, Bartosz. Well, as my fellow panelist was saying, is that the ESG non-credit rating analysis can help investors to understand what is how the business overall is managing different risks, how first of all it's exposed to which ESG risk, what is material, and how it's managing those risks, especially as Andrew was saying around the governance side of those entities, and how potentially those business entities are able to adjust their business strategy and their sustainability models based on the risks that they face within the industry and within the locations where they're based. So that's why it can certainly complement, and it can serve as almost an early indicator of where the red flags could potentially come at a later stage.
Rob?
There we are, yes. So thank you for the question. Yes, so I would piggyback on what Andrew said, and I think for credit, it's very clear, and I was happy to hear his focus. You know, credit investors are using ESG to help unlock additional information to understand credit risk, particularly over the medium term, even insights into the long term. And that's the focus. And I would imagine, and I think I've heard, that there's less emphasis of investors asking credit rating agencies to assess it for, you know, ethical or social norms or behavior. On the equity side, it's quite different, that there are a lot of investors who want their portfolio to align with societal values. So in addition to excluding, they also want their portfolios to tilt. And it's really unclear right now. I mean, there's no formal mechanism or lexicon to say, I want my investment to be 20% financial returns and, you know, or 80% financial returns and 20% social returns, or I'm willing to give up this amount in returns or add this amount of volatility for a good social cause. It's really hard to get to that point. But what you can say for equity is some of the elements of ESG in terms of the medium-term benefit of these social goods on the social side for brand value, some of the benefit for governance to support a medium-term growth strategy, and on the environmental transition to reduce the impact on the on climate change, and the benefit that has for the company as well as society. And I think the upside benefit would be captured a lot less in credit. There's still an element of resilience, but it would be captured to be less meaningful for the credit. Whereas for the equity side, there might be more upside benefit that way. And that's why I think that getting this rigorous assessment on financial materiality from the traditional credit rating agencies who've done this for decades and know the methodology inside and out, if they can make this more resilient and explain how they embed financial materiality or extract financial materiality from their existing approaches that may have a flavor of ESG, I think that would serve investors more broadly who may want to blend, but they may want to know it divided. I want to know what ESG means for materiality, financial materiality, and then I want to know what these longer term social benefits are, and then let me be the judge of how to put it together. And currently, I think it's very difficult. ESG, again, it's great in concept, but I think it needs to work more to get that aspect really clear.
Yeah, I mean, it's a very good question. And when we've taken what we've done out to investors, and we've talked particularly to ones who are integrated and longer term ESG investors, the way that they have described being able to use the very credit specific ESG scores that we're producing at an entity and a transaction level, and how to combine those with the longer term service provider views on, you know, ethical, moral considerations, etc., is what they say is it enables them to look at something like a mining sector in a region or a country, and to say that over the long run, this doesn't look sustainable running out past 15, 20 years. But that doesn't necessarily mean they don't want to invest in it in the shorter term. And the credit aspects enable them to take a view on whether they are picking up risk and volatility within a short-term time horizon. And the service provider views enable them to form more of a strategic view. And the way that they've described that for individual entities translating into strategic decisions for them is that, for instance, if we had a mining company at a stable, low investment grade rating and had it there for 10 or 15 years, it was still stable. but they felt that mining in that country wasn't long-term feasible beyond 20, 25 years because of some of the ESG service provider reports, then what they might well do is they might go long on the short-term bonds of that entity, because the market sentiment is contaminating pricing and causing it to shoot up because everybody's saying long-term this is an unsustainable business. But actually, if the credit is stable in the short term, there's a return to be had from that. Whereas because of the long-term risks, they might then go very short on the long term. And so in terms of how they combine that, I think that's how we see people using it at the moment. The real difficulty, and Rob's highlighted this as well, is that how you get those two different levels to cross over and mesh just isn't there at the moment. It really isn't. I mean, I smiled slightly when Rob said about the rating agencies not being asked about the ethical or the social aspects. In fact, we are actually asked about that. And I think the reason we're asked about that is because of the transparency around methodologies. And because the investors are frustrated with not being able to have that same clarity and transparency. However, you know, it isn't, as Rob well pointed out, that's not our forte. And so we are looking at ways in which we might be able to help in that respect, and how we might be able to, you know, improve some standardization. One of the biggest risks and issues that I think we find investors having a problem with is if you've got for instance, if you've got a conventional bond from Vodafone, is that better or worse than a green bond from an oil and gas producer like Repsol? How on earth do you assess that? There's no ability to assess that at all at the moment. And that comes back to Rob's point about skewing of portfolios and unintended consequences, and not being able to work out whether you're going to get alpha or whether you'll get volatility protection or whether you'll accidentally introduce it. The second part of your question was on regulation. And I think it is probably only a matter of time before the service providers become regulated. One of the consultations put out by ESMA at the end of last year had quite a throwaway paragraph towards the end of it, but it indicated exactly what some of the personal statements that have been made by senior people have said in the month since then, which is that they noted the increasing incidence of using service provider ESG ratings to form pricing triggers around KPI-linked bonds. And they made a very clear commentary in their consultation that said, we don't really like this. We think that's introducing an element of potential systemic risk into the markets that's unregulated. And if we continue to see this, we shall push even harder to regulate it. Now, there is a very fine balance to be struck between promoting development of the market and strangling it by regulation. I think Rob's already alluded to that. And the issue around standardization gets sort of parked while that market development is occurring.
Okay, I would like to briefly touch upon the question of bonds we just raised, because we all know that EU taxonomy is out, and I would like to pose a very short question because we are running out of time. How do you think that the EU taxonomy will drive the potential or the demand, as you wish, for ESG assessments? Maybe we start with Andrew this time.
Okay, and I promise I'll be quick this time. It's quite a short answer from ourselves. We actually think that it is more likely to drive regulatory momentum than it is to drive individual bonds. We don't think it's going to be the driver that forces a particular type of bond to come into existence. But what we do think is it will be used as a framework to guide policy setters. And having more of a common framework is something that I think everybody is keen to see across the markets.
Yulia?
Well, very important aspect of EU taxonomy that it is actually regulation around transparency, right? So it's not necessarily requiring investors to invest in sustainable finance and drop all the other assets, or for issuers to start issuing green bonds only. It's very much promoting the transparency in the market, which alluding to all this conversation that we're having, is the market actually needs. So it's very much welcome.
Rob?
Sure, I would agree with all of those comments, and I would just say that I really think the higher level is irrespective of the product, whether it's green bonds, transition funds, forms of ESG, or something else that comes up. At the end of the day, it needs to be very transparent. So if investors have an idea of what they're going to get out of it, that they're able to do their due diligence, it needs to be made available to them. So it's up to the investors to choose how they want to educate themselves and then how they want to run their own investments.
Okay. So thank you very much. Thank you to all of you for participating in this great, fruitful, and I believe useful for our audience discussion. And I hope we'll have opportunity to speak again. So thank you very much, ladies and gentlemen. Thank you. Stay tuned and be safe. Thanks.
Thank you.
Thank you, Bartosz. Thank you.